One of the things I've been wanting to do is to go through some accounting basics. There's a lot of our customers that, while they understand how to fix units and how to sell parts and run the basic day-to-day processes in a company, they really don't understand all of the complexities that go into actually doing the accounting that's involved in keeping the business going. Now, there's a couple different states of mind as far as accounting goes. One is probably the more typical, is that the company or the owner of the company runs the business, pays the bills, and figures the accountant at the end of the year can figure out what needs to happen for doing the taxes and making sure everything is being done correctly. Now, the problem with taking that tact is that you end up, one, not knowing what the business is doing throughout the year. You're always having to wait on an accountant to actually come back and tell you how much inventory you have and how much your company is worth. And two, you're making decisions based on prior years and based on your personal understanding of what's going on and not off of the actual facts of the numbers that are being run. So, for example, you know that you always sell a certain belt, and you've been selling it for years, so you have a min and max set to 10 and 20. But you miss the fact that unit that those belts are on are becoming less and less frequent, and you're not selling as many of them as you used to, and your min and max really ought to be reset. Or perhaps the vendor that you're getting them from, the majority of the time, they're not giving you a margin that's very good, and you're really not making that much money off of carrying that particular product. So there's a lot of reasons why it's good to keep up with all of the accounting. And Lizzy, or a system like Lizzy, actually allows you to do it without thinking a whole lot about it. So understanding what is being done in the background enables you to be able to figure out how to solve things that maybe you did wrong. Maybe you put them into the system wrong and you're having to figure out how to get things back to being right. And it also enables you to be able to better understand how to look at a balance sheet and how to look at a profit and loss and make sense of what you're looking at. And so setting up the accounting and getting Lizzy and everything all set up the way you want it to allows you to have access to information that you normally don't have access to at all. So as a result, when we sell Lizzy to our customers, we're not just trying to sell the product to them, we're actually trying to get them to use the product to its fullest capacity, because the more that you guys use the software, the more information you'll get out of it and the more useful you'll find having it will be. So what I want to do in this video is to actually go through the very basics of what Lizzy is doing and what a double entry accounting system is supposed to be doing in order to help you run your business. So to get started, what I'm going to do is I want to actually show you the accounting formula that is used by every double entry accounting system that's out there. So what we have is we have assets, and that all of your assets are going to equal all of our liabilities plus all of our owner equity. And I'm going to explain what all this stuff is as we're going through this. So this is the formula that every accounting system uses. So the first thing that you have to understand before we worry about debits and credits and all the other stuff that goes into a double entry accounting system, the first thing is, what is an asset? And I like to say that assets are the things that you would brag to your mother or your friends about. So for example, your checking account is an asset. How much inventory you have in your store is an asset. That's something that you would typically brag about. Does your company own a lot of office equipment? Those are things that we would brag about. So office equipment fits into this. So those are just a few examples. There's a lot of other examples, and some of them we'll get into as we go through this. Now, what is a liability? A liability is something that we don't want anybody to know about. So for example, if we have a lot of payables, those are liabilities that are on our books that we owe money to other companies or we owe money to other people. So a liability there would be a payable. If we have taken money from a customer because they ordered parts from us and we haven't actually given them the part yet, that would be a liability. And those are what we call customer deposits. So customer deposits would be good examples of liabilities as well. Now, another side of this is owner equity. So what is owner equity? Owner equity could be a lot of things. Sales would be one example of an owner equity type account. Other things are where you've invested money into the company, and so we're depositing money into the checking account, but we've got to tell it where that money came from. So investments and that type stuff would go over in owner's equity. Now, there are a few things that don't really make sense, but they just show up where I'm about to show you just because it makes the equation work a little better. But expenses would be something where we went and bought things for the company, or a cost of goods for inventory when we sell our inventory. Those things typically fit over here in the asset category, and they really just fit over there to help with balancing out the equation. They could be somewhere else. It really wouldn't matter, but they typically just sit over here in the asset column. Now, the big thing, and this is probably something that confuses most people about accounting when you start trying to learn this formula, because you'd have to admit right now there's really nothing very complicated. We have our assets, the things that we have, our liabilities, the things we owe for, and our owner equity, which is pretty much everything else. So the problems come in when we start talking about these two words, debit and credit. And the only way that I can try to make this as simple as possible is to tell you that if you're on the left-hand side of the equation, everything is backwards. So for you lefties out there, I'll go ahead and apologize, but a good example is left-handed people. When people are looking at them writing and stuff, it's a bit awkward. It's not really the way that most of us write and think. So debits and credits on the left-hand side are backwards to everything else. Everything over on the right-hand side of the equation is exactly what you would expect it to be. So if you look in the dictionary and you see that debit is to take away and credit is to add to, then you would be correct over here on this side of the equation. So as an example, if I told you that I wanted to add $20 to accounts payable to Office Depot, then I'm going to credit payables. I'm going to credit payables $20. And that would make sense because I'm adding to my debt, I'm adding to payables $20. But as soon as I come over here on the left-hand side of the equation, everything goes bonkers because debits are not debits and credits are not credits. They're the exact opposite of what you would expect. And that's all you really need to think about. So if you come over here to say inventory, this payable, this $20 worth of payable was me putting inventory into the system for $20. So I'm going to come over and we're going to do something to inventory and we're going to do whatever it is. We're going to do it by $20. Now, the best way to approach any accounting problem is to find the thing that you know, and the other thing will work itself out. So for example, we always know that debits and credits have to equal. They have to equal. And that means that if I know that I'm doing a credit over here on this side to add to my accounts payable, then I automatically know that I'm going to be doing a debit on this side. Now, by the same token, after you get used to this, you know that the debits or the assets are on the left-hand side of the equation, and therefore you're always going to do the opposite. So if I want to add to my inventory, I'm going to debit my inventory because it's the opposite of what I would think I would do. And then over on the right-hand side, we're going to do what we actually think we're going to do. Now, another example is, let's say that we're going to pay this purchase order. So now it's the end of the month and we're going to pay that purchase order. So we know we're going to be working with the checking account and we know we're going to be working with payables. So again, I'm going to come down here and I'm going to say, well, I'm paying my payables and we're going to pay $20. Well, what do we do when we pay a purchase order? We remove the liability. We're taking it away. So I automatically know I'm on the right-hand side of the equation and I'm going to debit my payables $20 because I want to reduce my payable or my liability by $20. So now the question becomes, what are we doing on the left side? Well, I know that I'm writing a check, so that's easy. I know that I'm writing a check for $20, so that's fairly easy. And I'm a little confused about this whole debit and credit thing on the left-hand side because it doesn't make sense to my brain yet. And I'm going to go ahead and tell you again, don't try to logically figure out what this is doing because it does not make sense. It is always going to be the opposite of what you think, no matter how hard you think about it. So if I come in here and I know that we have debited the payables, then that automatically tells me that I'm going to credit my checking account. Now, I'm removing $20 from my checkbook and crediting the account. So again, it doesn't make a lot of sense to us, but that's what we're doing in order to work this out. Because in accounting, debits must equal credits. They have to. There is no exception. And Lizzy tries very, very hard to make sure that nothing ever gets out of balance. So another example is, let's sell something and deposit the money into our checkbook. So I'm going to keep this very simple. So let's say that we are going to sell a product and we sold it for $50. And so looking at the equation up here, I know sales are over here on the right-hand side of the equation. So we automatically know that if I'm adding to the sales department or the sale, then I'm going to credit that particular account. So now we need to figure out what we're going to do over on the left side. Well, by default, I'm not going to physically take that $50 and take it to the bank as soon as I get it. I'm going to put it in a drawer and hold on to it. So in Lizzy, we have an account that we call undeposited funds. That's basically pretty self-explanatory. So undeposited funds, and we're going to add $50 to it. But again, if we're adding something to the left-hand side of the equation, it's the opposite of what we think we're going to do, which means we're going to debit that particular account. Now, credits and debits are 50 each, and everything balances out. Everything is good. Now, one more example, and hopefully this is kind of starting to make a little bit of sense to you, but another example is that we do not always have to work across the equal sign. We can do something all over here on the asset column or all in the liability column. So an example of that is, I want to take this $50 from undeposited funds and I want to put it into checking. Now, undeposited funds is an asset. It's money that is mine. It's in my cash drawer. So it is an asset account. I'm going to take that money to the bank and deposit it into checking. Now, what happens when I do that? Well, we know that we're going to, and I'm just going to write UF for undeposited funds. We know we're going to be doing something to undeposited funds for $50, and we know that we're going to be doing something to checking for $50. So these are the two things that we know, okay? And we know that we've got to do a deposit and a credit. So those are two things that we know, but we don't know which one is going to go which. Well, if I'm adding money to my checkbook, then I know, because this is opposite what it's supposed to be, I know that I'm going to be doing a debit. I have to debit an asset account to add to it. You notice up here when we brought the inventory in that we debited the inventory account to add to the inventory. So here we're going to be adding to our checkbook. So we're going to debit our checkbook, and as soon as we figure out one of them, we automatically know what we're going to do with the other because it has to be the opposite. Okay, so debits and credits have to equal. They can go across the equal sign, and a lot of times they do, and they can stay on the same side. But the fact of the matter is that debits always have to equal credits no matter what accounts we're working with. Now, by the same token, we can also come in here and add to one account and subtract from multiple accounts. So an example is I want to write a check. So I'm going to write a check and I'm going to pay a bill. But this bill is actually going to be to Office Depot. And some of the things that we're buying are office equipment. Some of the stuff that we're going to be buying is office supplies because we're buying some paper. Maybe we're buying a computer, so we've got a computer expense, whatever it happens to be. But all of the things that we're buying are going to come out of my checkbook. So let's say that we wrote a check for $200 to Office Depot. That $200 is going to be, hopefully you guessed it, a credit because we're taking money out of the checkbook. So this is going to be a credit, but then we're going to affect 3 different accounts over here. So let's say that we had $50 of this went to office equipment, and let's say that $50 of this went to office supplies to buy paper, and then $100 of it went to buy a new computer pad or mouse or something related to computers. So at this point, we have $200 worth of debits because all of these things are going to be debits, and then $200 worth of a credit. But again, at the end of the day, our credit equals our debits, and everything is good. So as long as our credits and debits equal at the end of the process or at the end of the thing that we're trying to deal with, then everything in that process is perfect as far as Lizzy's concerned. Now, the last thing that I want to talk about here is something that's fairly unique to Lizzy, and it deals with what we call protected accounts, and this probably frustrates CPAs more than anything else in the entire application. And I want to try to explain to you exactly why we use protected accounts and what they're for. So I'm going to go in and we're going to clear our board here, and I want to explain. And to do this, we're just going to start with checking. So let's say that we have a checkbook, and in this checkbook we come in and we do a deposit and we put in $100 into the checkbook. And then let's say that we write some checks, and we write a check out for $10, and we write another check out, and we go through the day and we're doing all of these different debits and credits in the checkbook. And an accountant comes up and says, well, you're actually supposed to have $200 in your checkbook. So instead of worrying about the checkbook, I want to make sure your general ledger is balanced and everything is correct so that I can do your taxes. So I want to go over to the general ledger. So we're going to go to the GL, and I want to debit your checkbook, and I want to put an extra $100 into your checkbook, and I'm just going to make that money magically appear from owner's equity. I don't really know why your checkbook is off. I just want to fix it because I don't have time to go in and reconcile your entire checkbook and figure out what's wrong. Well, Lizzy won't let you do this. Now, QuickBooks and some of the other accounting packages, they will let you go in and do this. In Lizzy, we are trying to provide you an application that you don't have to be an accountant to be able to use. And as a result, it makes more sense to you to go in here and find the missing deposit that we had up here to make our balance be $200. So if I'm missing $175 here, then I need to go find the $175 deposit and put that into the checkbook, because that will actually fix the problem, and now we can reconcile the checkbook without having to go and do manual entries inside the GL itself. Now, again, this makes it more difficult for an accountant because they don't have time to go in here and try to reconcile your whole checkbook for you. I'm sure they would, love to charge you to go in and do that, but it's not necessary. You need to be responsible for paying your bills and reconciling your checkbook. And just by the mere act of you doing that, Lizzy will keep up with this general ledger so that when the accountant comes in and looks, everything will be in the general ledger for the checkbook exactly the way it's supposed to be. Now, another example is inventory. So let's say that the accountant comes in today and they say that we're supposed to have $12,000 worth of inventory, but we are only showing $11,500 on the books. So this is our book number. This is what the CPA claims we're supposed to have. Now, the CPA is using whatever they have available to them. Maybe you're paying them to go through and look at all your receiving history and look at all your invoices, and they're manually going in and trying to figure out exactly what you're supposed to have on the books. But they can't see the manual adjustments, the lost parts, the stolen parts, the things that may not be in their accounting package. And it's easier for them to come over here and just tell you, hey, we need $11,500 on the books, or in this case $12,000 on the books. I need to do an adjustment for $500 in the GL. So again, they come into the general ledger and they try to come in and debit and credit to make everything balance the way they think it's supposed to be. The problem is that for every inventory item that we have, there is a cost associated with it on our books. And if you come back next week and you find a part that is not in stock, so you find a part that's not here, and you go in and adjust that item out, and let's say that it happens to be for $500, then their manual adjustment has now thrown your entire GL out of balance. So we're not out of balance as far as debits and credits go, but we're out of balance with that inventory. So our GL balance, if we go and look at every part we have in stock against the costing table, we come up with $11,500, but on the GL, it's going to say we have $12,000 because that's what the CPA said we had. And as a result, our inventory and GL are out of balance between each other. And Lizzy tries very, very hard to make sure that those two things never get out of balance. We used to allow these types of transactions, but it caused more problems in the long run than it was worth, because the dealer would go in and make an adjustment. They wouldn't realize what they were doing, and then the accountant would come in and make an adjustment, and then you guys are on the phone with us trying to figure out why the two accounts don't balance anymore. And as you can imagine, it takes quite a lot of time to go in and try to figure out where this manual GL hit came from and who put it in there, why they put it in there, and then trying to figure out how to remove it to get things balanced again. So it's just easier for us in the long run to lock those accounts. So all of these accounts inside Lizzy are locked accounts. You cannot go in and manually do a GL adjustment against them. There's no amount of complaining or conversation that is going to change that anytime soon. This is probably one of the things we do frustrate the CPAs, but it's one of the things that has eliminated a lot of the problems that we used to have with the dealers and business owners calling us up trying to figure out what was wrong in the different accounts. So what I've tried to accomplish here today is basically an introductory course to Accounting 101, what debits and credits mean, and why they are very important to Lizzy to make sure that they always balance, and then just a quick explanation of why some of the accounts inside of Lizzy are locked and you can't manually go into the general ledger to do an adjustment. You have to actually go to, for example, inventory or checking and do a deposit or adjust a part in or out of inventory to get things balanced the way they're supposed to be.